Hello and welcome to ACCA Masters. Today we'll be covering Chapter 19 of F3, Statement of Cash Flows. Statement of Cash Flows is one of the four statements that a company has to produce on an annual basis. The first three being Statement of Profit and Loss, Statement of Financial Position, and Statement of Changes in Equity. Now, what is the purpose of producing a statement of cash flow? If a business appears profitable on its statement of profit or loss, it may mislead the users of the financial statements. Shareholders might believe, for example, that if a company makes a profit after tax, then this is the amount which it could afford to pay as dividends as well. So, for example, if you're an investor of a company and you see that on the company's statement of profit and loss, there is a profit amount of, let's say, $100,000. Now, you may be led to think that this is how much money the company has and how much money the company can pay out as dividends. While the company has earned this much money during the year, it does not mean that it also has this much money in form of cash or in form of bank balance at the end of the year. Employees might believe that if a company makes profit, it can afford to pay higher wages next year. Same goes with employees. They look at this and they think maybe we'll get more wages next year since the company is doing very well profit wise. For a business to survive, it needs to have a good control on its cash flow. Now, the misunderstanding happening here with the investors and with the employees is that the profit amount is not directly indicative of how much cash the company has. When a company is making a profit of $100,000, it is very possible that the company also has a sum of more than $100,000 in cash. So let's say $150,000. But at the same time, it is also possible that the company only has maybe $60,000 in cash reserves and in bank balance. So this is very important to be disclosed to all the viewers of financial statements. If you're looking at the profit amount of the company, you also need to know at the same time how much cash the company has. Because regardless of the profit amount, any payments that are supposed to be made out, whether it is in form of dividends or in form of bonuses to employees, will have to be paid out in form of cash, right? Or in form of bank balance. Again, cash and bank balance, they're the same thing. It's basically how much money the company has. Could be in form of cash, could be in form of bank balance. So if the company does not have enough cash to pay out, if the company only has $60,000 in its reserves in its bank and it in the cash locker, for example, then the company has to manage their cash flows and make sure that they have enough cash to pay the upcoming expenses, because it's very likely that at the very start of the next year you will have some expenses to settle. Sometimes some of your expenses will have to be paid in advance, for example like rent or insurance. Now in those cases you have to need to have the cash ready to make those payments. If you don't make those payments on a timely basis, you can face penalties or fines or a bad reputation with your vendor. So you need to make sure that you have the right amount of cash available to make all these payments. So even though you've earned a profit of 100,000 during the previous year, does not mean that you also have enough cash to make all these upcoming payments. And so you need to manage your cash reserves very carefully. This may also mean that while you have a profit of $100,000, you are not going to pay out any dividends or any bonuses to employees because you do not have enough cash to make those payments. So despite having a good amount of profit, a company may not have enough cash to make these payments, and therefore the dividends amount might be very low, the bonus amounts might be very low, or they may be non-existent. So it's important for the viewers of the financial statements to understand this. If you only show them the profit of $100,000, they will think that the company is being unfair, the directors are taking the wrong decision by not paying out a good amount of dividends, and the employees will think that it's wrong for the company to not pay a good amount of bonuses. But you need to share this cash amount with the with the employees and with the investors and everyone as well. So they are aware of how much cash the company has, and therefore how many payments the company can afford to pay or to make to investors and employees and so on. Right, so it's very important to manage your cash balance. That's an important area of management for a company's accounting and finance department. So, what are the benefits then of making a statement of cash flows? We've already discussed one, right? It manages the expectations of your investors and of your employees. They can look at the cash balance and figure out how much cash they are expected to receive, or if they are expected to receive bonuses or dividends or not. Again, it will all depend on how much cash the company has. So that's already one benefit. Other benefits can include, for example, a statement of cash flow will be very easy to understand comparatively from a statement of profit and loss, because with the statement of cash flow, it's just your cash received and cash paid. So that's something that pretty much anyone, even without technical accounting knowledge, can understand. So that it's a statement that you can say can be very popular with some of your investors, because for them it will be easy to understand this aspect of the performance. It'll be easy for them to interpret the information without any particular accounting knowledge. It also gives a clear picture of the cash movements. It's not just the closing cash amount that you'll be presenting in the statement of cash flows. The idea is to present all the changes in your cash amount. The idea is to present all the changes that have happened, all the movements of cash that have happened with the business during the year. So, in the statement of cash flows, to put it in very simple terms, you will be showing how much cash you have received and where you have received it from, and how much cash you have paid during the year and where you have paid it. So, it will give a clear idea to all the viewers of the financial statements how the company has managed its cash flow over the year. Includes information not provided by other statements. Again, the changes in cash amount will not be included in the profit and loss statement or in the statement of financial position. Yes, you have the final cash amount mentioned in the statement of financial position. In current assets, we do have the final cash amount mentioned, but that does not show how the cash went from whatever it was last year to this amount in the current year, right? So the viewers of the statement of financial position specifically, they will see, okay, in 2023 we had this much cash amount, and now in 2024, at the end of 2024, we have this much cash amount. So they will be able to see this from the statements. But how did the cash amount go from being whatever it was to 2023 to now whatever it is in 2024? That is what you need to show, right? And that is shown in the statement of cash flow. Cash reserves are an indicator of company's performance. As I mentioned earlier, this is an important aspect of your overall accounting function or finance function. You need to manage your cash flows very carefully. A business can survive without profit. A business cannot survive without cash. So this is something that you really have to work on and make sure that you're managing your cash reserves properly and you're not running out of cash again and again. That will be a very difficult position to be in, and the business can face serious trouble if it runs out of cash and is not able to replenish its cash reserves. The statement of cash flows indicates the company's liquidity, where the statement of profit and loss shows a company's profitability. The statement of cash flows shows a company's liquidity. And again, that is just as important. Liquidity, in simple terms, is basically how easily you can make your due payments. This is your ease of making due payments. The easier it is for you to make your payments, more liquid you are, or the better off you are in terms of your liquidity. More difficult it is for you to make your payments if, for example, again, you don't have enough cash. then worse off is your liquidity position. And again, that's an important aspect. Like I said, perhaps you can survive without profitability for some years, you cannot survive without liquidity. So those were some of the benefits or purposes of making a statement of cash flows. Now, before we do a practical uh, numerical question on the statement of cash flows, let's look at the format first, right? As we have done with the previous statements, the format is very important in this case, especially because the format, you can say, is slightly complicated. It's not as complicated. I think if you go through it once or twice, do some numerical questions on it, you do become familiar with it over time. The best approach you can take to this, to understanding or memorizing this statement of cash flows format, is to understand it conceptually. Now, think about the statement of cash flows, right? I've already mentioned it includes all your cash received and all your cash paid. So shouldn't be that difficult, right? And it's not. It's just that you don't just present all your cash received and all your cash paid, right? It's not like you just write down all your cash received and then write down all your cash paid and take their difference. You have to divide your activities, you have to divide where you're receiving your cash from and where you're paying your cash to, between three sections, right? So investors and viewers of the financial statements can understand specific areas where your cash was used. So, first of all, we need to have a cash flow from operating activities section in the statement of cash flows. Now, in this, you will show all your cash received and all your cash paid relating to operating activities. Operating activities are basically your core business activities, your any of your production or office or HR or accounting related uh, expenses, purchases, all these business expenses are basically your operating activities. And then the second section of the statement is cash flow from investing activities. Now, this will show all your cash received and all your cash paid towards investing activities. Now, this is slightly separate from the business activities. This does not exactly show what the company does, but it is nevertheless an important part of your accounts management. So we do need to show a separate section for this as well. But the operating activity section says a lot about a company's performance. The better you are at managing your operating activities, the more feasible your business is, your business idea is. If you're doing well in terms of operating activities, the other two sections are more related to your accounts and finance and their performance. It's not related to what your business idea is and how successful your business is. But again, nevertheless, investing is an important part of a business. It's a reality, and you have to show your cash received and cash paid relating to investing activities. And then the third section is cash flow from financing activities. And in this one, again, you will show your cash received and cash paid relating to financing activities. Now, investing activities, again, to differentiate between investing activities and financing activities section, investing activities is wherever the company is making investments, wherever the business is making investments. Right now, the main area that a company will make investments towards is the purchase of non current assets, is basically non current assets. That is the most common type of investment that a company makes. It's the purchasing and using of non current assets. It's an investment because it's very long term, right? It's something that a company benefits from a number of years, and therefore this type of investment, it's not exactly related directly to your operations. It's a different sort of decision. You can always rent your non-current assets instead of buying them. So this is very much an investment, purchasing your non-current assets. So anything related to your non-current assets, for example, the purchase of non-current assets, or the sale of non-current assets will be shown in this section. And then you can make other investments as well. For example, let's say if you put some money into a savings account, right, that will be an investment, so that can go here as well, right? And then if you receive any interest from this investment, from putting money into a savings account, that interest received can be shown here in the section as well. So investment, the making of investment itself, and then any return coming from the investment again will also be recorded in the investing activities section. So for example, if you make an investment into another company by buying their shares, so you may receive some dividends from that company. So in that case, your dividends received will also be shown in the investing activity section, because this again is your return from investment. So these are the common sort of activities or common items amounts that you record in the investing activity section. The financing activity section basically is about where the investment is coming from into the company, right? So in this case, this is investment coming into the company, right? This is funds, you can say funds coming into the company, long term funds. Now these can come from two sources. We've already done this in a previous chapter. It can either come from shares, right, from equity. So everything equity related, for example, if you sell any shares, right, that will be recorded here, right? If, for example, you take a loan, right, debt as well, right, debt and equity, those are the two sources of finance for a company. So if you take a loan, that will be recorded in this section. And then when you repay a loan, for example, that will be recorded in this section as well. So these are the common items that you can see in the equity section. So and also dividends paid, right? That's another, that's a return that you are giving to your financiers, to your investors. So dividends paid will be recorded in the financing activities section, right? So these are the common items that you will see in the financing activity section. We'll look at a full-fledged format as well, but this was to give you a general conceptual idea for what goes in which section. And then the operating activities section, it's very it's made in a very specific way, so that should become quite clear as well once we look at it. So to start with the format of statement of cash flows, remember we have the operating activities section first. Now we start the statement of cash flows with profit before interest and tax, right? So this is the indirect method of making statement of cash flows, and this is the most commonly used method and likely the one that will be tested in your exam as well. Now, why do we use the indirect method of making statement of cash flows? Basically, it's called the indirect method because in the operating activities section, instead of taking the cash received from customers and the cash paid to suppliers and the wages and salaries paid, we basically start with our profit amount. The profit amount that we have calculated in the statement of profit and loss, right? This is specifically the operating profit amount, right? That is profit before interest and tax. We start with this amount and then we make adjustments in this amount to find the cash flow from operating activities. So instead of listing each item separately, we start with the profit amount and we just make adjustments in the profit amount to find our operating cash flow. So we start with profit before interest and tax, right? So it's an indirect way of getting to your operating cash flow by starting with your operating profit and making adjustments in it for non-cash items to find your operating cash flow. So we start with this, and now in this you have to adjust for everything that you have adjusted in the statement of profit and loss, but it is a non-cash item, right? The first non-cash item, the most common type of non-cash item that will appear almost in every statement of profit and loss is depreciation. Now you may remember in the statement of profit and loss, depreciation is included as an expense. We basically have to reverse the effect of all the non-cash items from the statement of cash flows. Depreciation is a non-cash item that we subtract in our profit calculation. You know, all expenses are subtracted in the statement of profit and loss. So just like that, depreciation is subtracted in the statement of profit and loss. We have to reverse that effect here because it's a non-cash item and we're trying to get to our operating cash flow from our operating profit. So what we do is we add back depreciation. That is the first adjustment you have to make. You add your depreciation. You can give this heading here or above profit before interest and tax, either should be fine. So we add our depreciation first of all, right? Again, we're adding a non-cash item that was adjusted in the statement of profit and loss when we were calculating profit before interest and tax. The another very common non-cash item that is usually adjusted in the statement of profit and loss is any profit made on the sale of non-current assets, on the disposal of non-current assets. Since that is added as income in the statement of profit and loss, we have to subtract any profit made on disposal from here, right? We're reversing the effect of a non-cash item that was previously adjusted when calculating profit before interest and tax, right? If we had a loss on disposal, you may remember, is subtracted as an expense in the statement of profit and loss. So any loss on disposal, if that was given in the scenario, that will have to be added here, right? So if there's a profit on disposal, that is subtracted in the statement of cash flows. If there's a loss on disposal, it has to be added here in the statement of cash flows. Again, opposite of what you do in the statement of profit and loss with these items. So those are two of the five most common adjustments that you have to make in this operating activity section. We've done two of them. Then we move on to the current assets and current liability adjustments. Basically, you go to your current assets section, right? And you find your inventory value from this year and you compare it with your inventory value from last year, right? That comparison will let you know if the inventory value has increased or decreased from the previous year to this one. So for example, if you're making the statement of cash flows for 2024, right? So you look at your inventory value, and this will be given to you in the scenario. You look at your inventory value of 2023, let's say it was 10,000, and you look at your inventory value now at the end of 2024, let's say it's 12,000, right? So here we have an increase in inventory value of 2,000. Now if your inventory value is increasing, you subtract that in the statement of cash flows. You subtract your increase in inventory. If your inventory value is decreasing, then you add it in the statement of cash flows. So you can remember what you do if the inventory value is increasing, and for decrease it is the opposite of that. So if the inventory value is increasing, we subtract it from the statement of cash flows. The logic here is that in order to get this extra inventory, the business must have paid some money. So that is what we're subtracting here. In order to get more assets, you need to make payment. Same is the logic we use for receivables. We look at the receivables amounts as well, right? We do this for all current assets except cash. So we look at then the receivables amount, which is also likely to be included in your current assets. We look at the receivables amount for 2023 and compare it with the receivables amount of 2024. And if the receivables amount is increasing, we subtract it in the statement of cash flows. Again, the same logic applies here. If it's an asset and it is increasing, then you must have paid for it. So by that logic, any increase in current assets is subtracted in the statement of cash flows, operating activity section. And if there was a decrease in one of your current assets, that will be added here in the operating activity section. And then you go to your current liabilities where you're likely to find trade payables. Now in trade payables, it's the opposite. So if your trade payables are increasing, you add them in the statement of cash flow. So you find out what your trade payables amount is last year and what it is this year. You compare them, you find the difference. And if it is increasing from last year to this year, like inventory was increasing here, then you add that increase in trade payables in the statement of cash flow. If your trade payables are decreasing from last year to this year, then you subtract them in the operating activity section. So the logic again, it's the opposite of what we do with uh, with assets. With liabilities, if they are increasing, then that means you must have saved some money by not settling those liabilities. So, by that logic, we are adding any increase in our current liabilities here in the operating activities section. And we'll do this for all current liabilities, although trade payables is likely to be the only current liability you come across. Again, we don't do it with bank overdraft because bank overdraft is basically a cash item and therefore it's not to be adjusted here. We use the cash items at the end of this statement of cash flows. So once we have these adjustments made of our current assets and current liabilities, again, just to sum up, any increase in current assets will be subtracted and any increase in current liabilities will be added here in the operating activities section. So overall, you end up with these five adjustments that you have to make in the operating activities section. You can memorize these five adjustments and it will always be the same five adjustments you have to make in the statement of cash flows. There might be one or two other current assets like accrued expenses or prepaid expenses. You can adjust for those as well, but mainly it will be these five adjustments. So once you have done these, you can total this section, right? And you will end up with your cash generated from operating activities. Let's say that is 105,000. So this is 95,000 with all of these amounts added and subtracted as necessary. And you have your cash generated from operating activities section. Now this is not quite done yet because there are two amounts that appear after profit before interest and tax, namely interest and tax, right? Which have not yet been adjusted here. So now we need to subtract any interest paid and any tax paid during the year. Right? These all these are assumed values. Again, you're likely to get them from the scenario. Once you have your interest paid and tax paid amounts, you subtract them from your cash generated from operating activities and you get your net cash from operating activities. This is the end of the operating activities section. Again, this is the indirect method, so that is why we have not directly taken the cash received and the cash paid and all that. We have instead started with operating profit and ended up with operating cash flow. Once you're done with the operating activities section, you will continue on. I'm continuing with the same format, right? Continuing down here from net cash from operating activities. The next section, as we talked earlier, is the cash flow from investing activities section, and this is about your non-current assets. So now you can start using the logic of if you bought it, then you must have paid for it, right? So that's a subtraction. And if you sold something, then you must have received money for it. So that's an addition in the statement of cash flows. If cash is received, it's a positive balance. If cash is paid, it is a negative balance. So for example, when you purchase non-current assets, you're paying for that, right? So purchase of non-current assets will be subtracted here in the investing activity section. When you sell your non-current assets, you receive money when you sell non-current assets, that will be added here. The sale proceeds, the cash received from selling the non-current asset will be added here, right? Because again, it's cash being received. And then we have interest received, again, amount received, return from your investment, so that will be added here. Dividends received, again, return from your investment, that will be added here as well. So these are the common sort of adjustments that you'll come across in the investing activities section. Uh, Once you're done with these, you can again total them and you will get your net cash from investing activities. That will be the final amount from the investing activities section with everything added and subtracted from the investing activities section only. Right, we're keeping the final balances of these sections in the main column. So we still have the 60,000 from net cash from operating activity section, and now we also have the 20,000 positive from the investing activity section. These balances can be negative as well, especially for the investing activity section, because sometimes you'll be purchasing non-current assets with a very high value, and therefore it will be a negative balance in the investing activity section. But that's not necessary, but it can be a negative balance, the point being. Now we have cash flow from invest financing activities section. Now this is where again your debt and equity are adjusted. So for example, if you're issuing shares, when you issue shares, the company gets cash for that. The company receives cash for that. So this money will be added here. If you're taking a loan, right? Receipt of a new loan. That is you taking a loan. Again, the company is receiving cash in this case. So that will be added here as well. If you're repaying some of your loan, if there's a repayment of a loan, that will be subtracted here because then now you're paying money, right? So any payment is a negative balance in this cash flow statement. It's like an expense. And then if you pay some dividends to your shareholders, again, that is related to your financing as well. And this is because it's a payment, it will also be a negative balance here. So once you're done with all these balances, you can total your financing activities section and you will get your final balance from the financing activities section as well. That is 15,000 positive here. Now, once you have your balances from all three sections, you can total your balances, add and subtract them as necessary. Again, these balances can be negative, so don't be too surprised if they are. You add and subtract them, as they are. Now, in this case, they're all positive balances, so they'll be added together, and we get a total of net increase in cash and cash equivalents of 95,000 because overall we're getting a positive balance from our cash statement of cash flow. That means that overall we have received more cash than we have paid. Now you have your net change, you can say, or net increase in this case. It can be a net decrease as well if you end up with a negative balance. But in this case, we have a net increase in cash and cash equivalents. You can then add in this the balance you had, the cash you had at the start of the year, right? You can add your cash and cash equivalents at the beginning of the period. Cash and cash equivalents are basically all your cash and your bank amount added together, right? So your cash and cash equivalents at the beginning of the period were 100,000. During the year, you have received 95,000 extra, more than what you have paid during the year. So now at the end of the year, your closing cash and cash equivalents must be 195,000. So that is what we're going for, right? Finding the closing cash and cash equivalents balance and showing in the statement how this balance was reached, what changes occurred in our cash amount, how much cash was received, how much was paid, and exactly how we went from 100,000 at the start of the year to now 195,000 in total cash at the end of the year. Right? So that is your statement of cash flows format. Now, here's a technique that I wanted to cover. If you are unsure about whether something will be adjusted in the statement of cash flows or not, you can always look at the double entry for that transaction, and that will tell you if that item should be adjusted in the cash flow statement or not. For example, consider a bonus issue of shares. Now, for the bonus issue of shares, the double entry is debit share premium, credit share capital. The cash account is not involved in this case. So this amount will not be adjusted in the statement of cash flows. Only amounts where only entries or transactions where the cash account is used to either make a debit or a credit entry, only those transactions will also be included in the statement of cash flow. Right. So for example, if you consider a rights issue of shares, now the double entry for the rights issue of shares is debit cash, credit share capital, and possibly credit share premium as well. So in this case, you see cash is being debited, which means we're receiving some cash. Now this will be included in the financing activities section of the statement because in this case we are receiving cash. So whenever you're confused about whether something will be included in your statement of cash flows, especially in the investing and financing activities section, you always imagine the double entry for that transaction, and if the cash account is involved, then that transaction must be included in the statement of cash flows as well. So consider, for example, a revaluation of non-current assets. The double entry is debit asset, debit accumulated depreciation, credit revaluation surplus. So the cash account is not used here. And rightly so, this transaction, this revaluation is never included in the statement of cash flows. So if you're confused about whether you've come across a new item that we've not discussed and you're not sure about whether it should be included in the statement of cash flows or not, imagine the double entry of that transaction and that should tell you if that transaction should be included in the statement of cash flows or not. Again, it will be based on whether there's an entry made in the cash account for that transaction or not. Right? So That's a bit of a technique you can use to figure out if you're confused about any items. Here we have a scenario where we have to prepare the operations, operating activities section specifically. Now we can see that the profit before the tax has been given of $434,850, right? We can start the statement of cash flows. Now you see we have to start the statement with profit before interest and tax. Here we only have profit before tax. If they give you profit before tax, that means interest has already been subtracted from this. While in reaching to this $434,850, the interest amount has already been subtracted. So what you can do is add back the interest amount to this to get the profit before tax. So $434,850 plus the finance cost of 35,000 given in the scenario will be added to your profit before tax to get profit before interest and tax or operating profit, and that is what you will start the statement with. Your profit before tax plus your interest amount, and that will give you the profit before interest and tax. You start your statement with this, and then the first adjustment is addition of depreciation. We have been given depreciation here of $37,400. Now we know we have to add this depreciation in the statement. They're also telling us that this includes a loss on disposal of 77,600. Now you can do this. You can subtract the loss amount from 37,400 and add the depreciation amount first and then add the loss amount, because loss from disposal is also supposed to be added here. Or you can add this together as one amount as depreciation, and maybe you can write something in the brackets. For example, the depreciation also includes loss on disposal, right? You see, it doesn't make a difference, because either you can add the just the depreciation amount here and then you can add the loss amount here, right? That will be fine as well. Or you can just add the total amount of 37,400, and it achieves the same purpose. So the presentation is very much in these little bits. It's kind of interchangeable to some extent, not too much. Although I think it will be better eventually if you separate the depreciation amount here, which will be 37,400 minus 7,600. uh, so that will be about 29,800. So it's, I think it'll be better to show the depreciation amount here separately, 29,800, and then also add the loss on disposal of 7,600. Although again, this is what we've gone with here, so that is fine as well. We have added the depreciation and the loss on disposal. Then we have to adjust for the changes in current assets and current liabilities. Now we can see, first of all, we have the inventory amount here. Inventory was we're making this statement for 31st December 2016. So inventory last year was 167 and now it's gone to 145. So we can see that there is a decrease in inventory amount. We take their difference, and decrease in inventory will be added in the statement of cash flow. So the difference of 22,000 between last year's inventory and this year's inventory will be added here. In the trade receivables amount, we have again a decrease in the trade receivables amount of 1,000, and that will also be added in the statement of cash flows. Any decreases in current assets will be added in the statement of cash flows. Increases obviously will be subtracted, but we don't seem to have any here. We do have a prepayment, right? There is increase in prepayment. Prepayment, you may remember, is an asset. So our prepayment is increasing from last year to this year by 11,000. Now that is an increase in assets and therefore will be subtracted um, here in the statement of cash flows. Decrease in receivables is added, but increase in prepayments will be subtracted. Since again, remember, if there's an increase in current assets, you have to subtract it in the operating activity section. Then we can move on to our trade payables. Trade payables have decreased as well from last year to this year. Any decrease in current liabilities are subtracted. So decrease in trade payables here will be subtracted from the operating activity section. Now we will not be adjusting the interest payable amounts since interest and tax paid amounts are adjusted separately after we have cash generated from operating activities. If we were to continue this statement, we would have subtracted the interest paid and tax paid amounts after here. Interest paid and tax paid would have been subtracted from here. So if you're adjusting these amounts elsewhere, then you don't need to account for the changes in interest payable, or if there was tax payable given here. These are obviously current liabilities as well, but we don't account for changes in interest payable or tax payable because we are adjusting the interest paid and the tax paid amount elsewhere in the statement, right? But if there are prepayments or accrued expenses and there are changes in those amounts, you should adjust for those in the operating activity section. So that is our cash generated from operating activities. Now, let's look at the direct method briefly. Here, the direct method of statement of cash flows is very straightforward if you prepare it directly. Right here, we have well, basically, the direct and indirect method really is different in the operating activity section. The investing activity section and the financing activity sections will look the same regardless of whether you're using the direct or indirect method. The difference only happens in the operating activity section. The direct method in operating activity section is very straightforward. You directly take the cash received from customers, you add that here. You take the cash paid to suppliers, you subtract that, right? So we're taking our main business related amounts. Then we take the cash paid to employees, that is subtracted here as well. Obviously, it's a payment, right? So we do it very logically with the direct method. With the indirect method, we have to go with the, with the adjustments in our profit amount, and that will give us the cash generated from operating activities. Then we can subtract the interest paid and the tax paid to get our net cash flow from operating activities, right? So that will pretty much cover our direct method of statement of cash flows. You may have other operating expenses and payments for those operating expenses as well that you may have to adjust in this section. Cash paid for other operating expenses, so you may have to subtract those if you are using the direct method as well. But again, it's more likely that they'll test, and it's more commonly to use the indirect method when preparing your statement of cash flows, right? So just to be a bit familiar with the direct method of statement of cash flows, this is what it looks like. Again, the sections following operating activities will look the same in direct method as well as they look in the indirect method. So here we have a full-fledged question. We've been given the statement of profit and loss. You can pause here and look through it just to familiarize yourself with it. Here we have the statement of financial position of the same business. This is a more full question. You can pause here and familiarize yourself with the statement of financial position as well. And then we have some additional information given. You can go through this as well just to familiarize yourself with it. Now, based upon the available information, we have to prepare the statement of cash flows using the indirect method. So we have the statement of profit and loss given here. First of all, we'll start with the format, right? Remember, you have to memorize the format uh, just to be very comfortable with the statement of cash flow questions, right? You start with profit before interest and tax. Now, in this case, we have loss before tax, and we also have the interest amount given here. So in this scenario, we can see that we have the loss before tax, and we also have the interest amount here, right? The distribution and administration expenses are obviously operating expenses. So if we have the loss before tax and we have the interest amount, we can add back the interest amount in our loss before tax to get our loss before interest and tax. So just like we did with profit before tax, we added back the interest amount to get the profit before interest and tax. Much like that, we just have a loss in this case, but other than that, except it being a negative amount, it's not that different. So instead of starting the statement with loss before tax, we always add back the interest in this amount to get our loss or profit before interest and tax, and we start the statement with that. Now, following this, we start with the operating activities section. And we start with the first adjustment, that being the depreciation one. Again, you can pause this here, and if you want to give it a try, you can complete this on your own and then look through the answer. Although feel free to look through the answer first, and then I'll be assigning some practice questions at the end, so you can attempt those as practice. But again, that's up to you. So in the operating activity section, the first thing we have to adjust for is depreciation. The depreciation is 11,000 that has been given here in the scenario. If we look through additional information, point B gives us the depreciation charge for the year of 11 million, right? And that is what we add here in the statement of cash flows, the first adjustment in the operating activity section. Then we have to look for profit or loss on non-current assets. So we have to calculate the profit or loss on disposal, right? They're telling us that they had scrapped some plant and equipment during the year. In point A, scrapped obviously means that they sold or basically stopped using, discontinued some of the non-current assets. The items scrapped were originally purchased for 7 million and they had a carrying amount of 1 million at the date of disposal. So basically the sale proceeds here are zero. When they say scrap, they basically mean they threw away the non-current assets, uh, completely stopped using them, but did not sell them to anyone. So the sale proceeds were zero in this case. But the carrying value of these non-current assets, as we can see from the scenario, was 1 million. So we will use this information to calculate our loss on disposal. In this case, that will be 1 million itself. And because loss on disposal is added in the statement of profit and loss, subtracted in the statement of profit and loss, we will be adding it here in the operating activities section. So we have added our depreciation, we've added our loss on disposal. Then we'll go to the adjustments of our current assets and current liabilities. First, we have current assets. We can see that the inventory amount has gone from 33,000 to 30,000. That's a decrease of 3,000 in inventory. That will be added here. Receivables have also decreased from 52 to 48,750. So the decrease in receivables will be added here as well. And then we have to go to our payables amount. Payables amount is not showing here, but the if we scroll back to the full statement of financial position, I'm sure we can see the change in payables amount. The payables section, current liabilities section is here, and here we have the trade payable amount of 27,500 in 2011, and then 26,300 in 2012. So we can see that there was a decrease in payables of about 1,200,000, and that is what we will subtract here, since decrease in liabilities, current liabilities is subtracted. So 1,200 decrease in payables will be subtracted here in the operating activities section. Now, once we're done with these adjustments, the five common adjustments will total our operating activities section. We're getting 13,750 for this. From this, we have to subtract interest paid and tax paid. So we'll find our interest paid amount for that. We again have to look to additional information. I'm sure interest paid amount is either, well, this is how you can figure out the interest paid amount. You go through your statement of profit and loss, and you can see that the interest paid amount here given is 1 million, right? 1,000 basically. The values are in thousand. So the interest payable amount here is given as 1,000. But then if you look to your statement of financial position, right, you can see that there is no interest payable in the current liabilities section, right? In the current liabilities section, we have bank overdraft, trade payables, and income tax. So basically, there was no interest payable at the start of the period or at the end of the period. That means that this $1,000 of interest was paid in the same year, was paid during 2012 as well. So the interest amount from the statement of profit and loss can sometimes be the interest paid amount as well. So we subtract this interest paid from our operating activities, cash generated from operating activities, and then we have to find the tax amount. Now, for the tax amount, we'll have to do a bit of a calculation, right? Here we have we can see that in the current liabilities, we have income tax mentioned in the current liabilities, and that was 5,000 last year, right? Now we have income tax recoverable of 500, right? So in this case, we may have to do a bit of a calculation. We can also see that in additional information in point C, we have been given a bit of extra information about income tax. Outflow estimated that it would receive a tax refund of 500,000 as a result of making a loss before tax for the year ended 30th April 2012. So while last year we had to pay 5,000 of income tax, this year we have to receive $500 of income tax from the tax authorities. This can happen if you make a loss for the year instead of a profit. So we have to do a bit of calculation. We start with the opening tax payable, the opening current liability. In from that we subtract the tax recoverable for the current year, right? And now we know that the closing tax recoverable is also 500,000. So we adjust for these and we get the tax paid amount for the year. That will just be 5,000, since that is how much tax was due last year. Basically, to get the tax paid amount, you can pretty much look at your current liabilities. You will always have a tax payable amount in your current liabilities for the previous year. Basically, you pay your tax in the next year. So this tax that belong to 5,000, that 5,000 tax that belong to 2011 was payable for 2011, but it will be paid in 2012. It will be paid in the current year. So that is what will be paying during this year, and that is your tax paid amount. And so for the tax paid amount, you can pretty much look to your current liabilities, and it will show you how much was tax was payable last year, and that basically is how much tax you must have paid this year. So your tax payable from the current liability section from last year is your tax paid amount for this year 90% of the time. And you can always use this equation to calculate the tax paid amount as well, although it's very unlikely to be different from the tax payable from last year. So once we have the tax paid amount, we can total that and we get our net cash from operating activities. Now the operating activities section is done. We're continuing on with the investing activities section. And for that, we need first of all the purchase of non-current assets. You can use this format with all the values included here for non-current assets. We have the cost of non-current assets, right? The opening balance, first of all, of non-current assets, 245,000. That is how much non-current assets we had in terms of cost at the start of the previous year. Sorry, at the end of the previous year or at the start of this year. Then we have the accumulated depreciation as well from last year, right? At the end of last year, or basically whatever the balance is at the end of last year, must be the opening balance for this year. So the opening balances can be taken as whatever the balances were at the end of last year. So we have the opening cost and the opening accumulated appreciation, and now we have to consider the disposed amounts. From additional information, we know that an asset with a cost of 7 million was disposed. So we subtract that 7,000 here from the opening balance. We also know that this disposed asset had a carrying value of 1 million. So the other 6 million must be your accumulated depreciation. Whenever you dispose an asset, you exclude all of the values related to that asset from your accounts, and that is what we're doing here. We're subtracting the cost of the disposed asset from the cost column, and we're subtracting the accumulated depreciation of the disposed asset from the accumulated depreciation column. Then we have to adjust for the depreciation amount for the year, which obviously gets added to the your total depreciation. And we also were told about a revaluation. We can see that the revaluation surplus on property, plant, and equipment has been given another comprehensive income section of 2,000, 2 million, right? Because the values are presented in terms of thousand. So that is your revaluation on non-current assets made during the year that will be added to your cost column, right? And that gives you the closing balances for your cost and your accumulated depreciation. Now, basically, because you have your closing balances, you can now calculate the value of assets that must have been purchased during the year. The closing balances for cost and accumulated depreciation we have taken directly from the statement of financial position for 2012. So we put in the closing balances and then we can balance these accounts to find our missing purchases value for the year. This is a full-fledged format that can be used to find either the value of assets purchased during the year. You can also find the value of assets disposed during the year. You can also find the depreciation amount for the year. Obviously, the rest of the balances in that case will be given, and you can find any of these balances if they're missing in the scenario with using the rest of the balances that would be given in the scenario. So if they want you to find depreciation using this method, all the other balances will be given. You can put in those balances and you can find the depreciation amount. So we get the purchased non-current assets of 20,000. For purchased assets you pay, so 20,000 will be subtracted here from investing activities. There are no other, we did not sell the assets for any value. We did not receive any money from selling the assets. So there is no sale of non-current assets that has to be added here. They're also not telling us about any interest received or dividends received during the year. So that completes our investing activities section. So that's a negative 20,000. As I said, these some of these sections can have a negative balance in them at the end of the year. Then we have the financing activity section. Now for that you can look to your to your equity section. In the equity section we can see that the uh, equity has the share capital has gone from 40,000 to 44,000, and the share premium has gone from 4,000 to 5,000. So that is a total increase of 4,000 in share capital and 1,000 from in share premium. So overall that is an increase of 5,000 that must have happened because you have issued shares, and therefore you must have received cash for this as well. So shares issued of 5 million will be added here because you've received this much cash from issuing shares during the period. Again, you can find this by taking the difference between your share capital and your share premium amounts. We also have a new loan received. If you look to your non-current liability section, you can see that the non-current liability has gone from 8,000 to 15,500. You can call this 8 million or you can call this 8,000 again, as far as you understand that the values are presented here in form of thousand. So this is 5 million, but we're writing it as 5,000 because the other 1,000 is represented up here. All these values have an extra 1,000 at the end of them. So this 20,000 is actually 20 million. Let us know if you don't understand this presenting values in terms of thousands, and we'll be sure to cover it in one of the upcoming lectures. So we have 8 million, right? Non-current liabilities, long-term loan at the end of last year, and then we have 15.5 million long-term loan at the end of this year. So the non-current liability has increased by 7,500. So that is how much loan you must have taken during the year, right? And again, if you take a loan, you're receiving money, so that will be added here in the statement of cash flows. We also have some dividends paid during the year. We can find that out using the retained earnings value, right? We use our opening retained earnings. Remember, retained earnings will always have two adjustments in them, usually the addition of profit and the subtraction of dividends paid. So we have our opening retained earnings of 77,250. We have our closing retained earnings of 72,450. We have the loss for the year of 3,800. That was again given in the statement of profit and loss, right? So once we have our opening retained earnings, our loss for the year, if it was profit, it would have been added. If it's a loss, obviously that's a negative profit, so it's subtracted. We have closing retained earnings here. We balance this to find our dividends paid during the year. That will be 1 million. The calculations that we've looked at for dividends paid, for non-current assets, for tax paid, you can use those calculations pretty much in every scenario. So you should know how these calculations are working. These are basically the accounts of retained earnings and non-current assets presented in calculation form. So you can do it, you can do these calculations using the accounts, or you can do them using this calculation. Either way is fine, just as far as you know one of the two methods. So you get your dividends paid from the retained earnings calculation. That is a payment, so that will be subtracted in the financing activities section, and then you can total your financing activities section. We have the balances from all three sections. We'll add and subtract them. Overall, here we have a negative balance because a lot was paid, a lot was invested in your non-current assets comparatively with how much cash you have received during the year. So overall, there has been a net decrease in cash and cash equivalents during the year of 750. Now to find the opening cash, the opening cash and cash equivalents for the year, you need to take your bank overdraft, right? Your bank overdraft was 3250, right? Either you will have a bank amount or a cash amount, right? Which means a positive opening balance. But if you have a bank overdraft, that means you owe some money to the bank. So that is obviously a negative opening balance for your statement of cash flows. You have a negative opening cash and cash equivalents. And now during the year as well, you have made more payments than you have received, and therefore you have a negative balance here in the for the net for the year as well. So your overall overdraft balance will actually increase to 4,000. As we can also see here, the bank overdraft has gone up to 4,000 for this year. So your closing balance of the statement of cash flows should match your closing balance from the statement of financial position for the current year as well, and that tells you that you've pretty much made all the necessary adjustments. So that was the statement of cash flows. It's a lengthy calculation. They don't usually give you the whole thing in one question. It's usually MCQs. As you can try these from the Kaplan kit, 416 to 437. They're all statement of cash flows questions. So do give these a try. They usually test one bit of the calculation, one part of the statement of cash flows you're asked to calculate for. So give them a try. We've attempted a full-fledged question on statement of cash flows. You can try that as well again if you want. Feel free to let us know if you face any issues with the Kaplan kit questions, or with the if you have any follow-up questions about today's lecture. And we'll see you in the next lecture. Take care. Bye bye.